In this video, I'm going to compare how my individual share purchases as a mini portfolio has gone compared to the alternative, which for me was basically just buying a simple ETF like VAS. And the reason for this is in my share portfolio overall, I've got about 80% of my money in ETFs and about 20% in individual shares. And one thing I've never done is actually taken a moment to compare how purchasing individual shares has actually gone compared to, say, just buying simple ETFs. Now, I should definitely call out, there's not going to be any financial advice here. If anything, you should not be doing half the stuff I do. So here's how the comparison is going to go. I'm going to look at my individual share purchases as one portfolio where I've, done some research and, yes, we are all reading the balance sheet and cash flow statements and all of that, I'm sure. But anyway, I've done the research and I've said I'm going to purchase this share at this time and I'm going to sell it at this time. And that's the other thing I will say is these are all realized gains and losses. This is not paper gains and losses. I've actually bought and sold and locked in whatever happened. And the comparison is going to be with purchasing VAS as an ETF. So this is now a table of all the individual shares and purchases that I made over the last couple of years. 7. And you can see a broad brush which should tell you it's an example of a man who's not really got a clear-cut strategy. You've got miners, not even specific miners. You've got lithium mining and iron ore. You've got a health insurance company, not even the biggest in Australia. You've got a bank and only one of the banks. You got Telstra, which is, everyone knows Telstra, TWE and AGL. And I know some of you are sitting there saying there is a special place in hell for you, Sanji, for that AGL purchase. What are you trying to do making money on coal, electricity, and all of that? Well, as you'll see, don't worry, I was punished adequately for that purchase. Okay, so here's a breakdown of the actual holdings in terms of gains and losses. What you're seeing is a variety of holding periods here too. You've got 3 months for FMG, and that's why I've sort of halved the gains. I technically made a 43% gain, but because it was within the 12-month capital gains period, I've sort of said relative to the other holdings, I'm going to halve that gain. That may be right or wrong, but that's what I've decided to do. The rest are all stock standard holdings. I think the longest was AGL, which is 25 months, but the rest are all above 12 months as well. Now, I don't actually spend time comparing each holding because that's not really what I want to talk about here. It's about how does these gains and losses compare to the next best alternative for me, which was to buy VAS. Or I could have put A200 or VGS or any ETF that you think you would have purchased as an alternative to purchasing these. And what I can see is in 4 out of the 7 cases, I did well. I actually did do better than having invested in the market, if you want to define VAS as the market. But in 3 of the cases, I did poorly. I underperformed against just performing in VAS. I should have just bought VAS in those cases. Now, the question I should really be asking is, well, how did these gains and losses come out in net? Did the 148% gain of Galaxy make up for that 42% loss by AGL? Because that's where this next graph is probably going to come in handy. And what I've done is essentially turn the actual gains and losses into dollar numbers. So you can see the actual magnitude of the gains and losses against each other. And it's a bit of a waterfall where you can see the AGL loss was massive. TWE loss was reasonable. I don't think I put in as much, and so the losses didn't actually turn out to be as much. Telstra and Westpac, NIB and FMG, basically you could see in this graph, if you look at where AGL starts and where FMG finishes, I pretty much made up for my losses with my little gains across there. And then my actual overall gain in my individual portfolio really came from Galaxy. You could rejig the numbers whichever way you want, but that's the general idea of how I'd interpret it. Now, what was the actual numerical gain in percentage, Sanji? Good question. That's where I would say my overall gain over the period of holding that portfolio was 14.7%. The equivalent portfolio, if I had just bought and held VAS, would have been 14.5%. Now, my takeaway from this is not that I did better than VAS. My takeaway from this is I did pretty much the same. I should have just bought VAS because when I tried to do individual share purchases, it was all over the shop. I had some great gains, I had some great losses, and I would have achieved the same as just buying VAS. Now, I know some of you might be sitting there thinking, hang on, the numbers don't quite stack up. How can your 150, 148% gain achieve the same dollar value as just a 14% gain overall on a broad ETF. It comes down to the underlying dollar value of each purchase, right? So for example, if I invested $5,000 and I achieved a 50% return, that's a $2,500 gain. 50% return, that's great. I'm getting phone calls from Ray Dalio and all that team saying, come and work for us. Sanjay, you're pulling 50% gains outside of crypto, my goodness. I'm joking, obviously. But if I had invested $20,000, a $2,500 gain is only a 12.5% gain. And that's essentially what's happened is my purchase in Galaxy was great. It achieved great returns, but it was only one part of six other purchases I made of smaller dollar value. And what I'm saying is it was better off if I, instead of buying 6 different companies or 6 or 7 different companies and putting smaller amounts in each one and seeing some great gains and seeing some great losses, it was better if I had just bought one ETF and seen a moderate gain on that. I would have achieved the same dollar value gain as with the other one. So what are my key takeaways out of this? What are my key principles that I should learn? A bit of a shout out to Ray Dalio and what I can learn from the mistakes I've made. Number 1, I should definitely stick to ETFs pretty much all the time. The only times I seem to do generally well in a way that I can say that I actually wasn't lucky, that I actually thought it through, did a bit of research and achieved something, that's probably when it comes to mining companies. And it makes sense, it's probably a domain that I understand, and I'm more confident in buying that kind of stuff in times of uncertainty. But at the end of the day, anything outside of mining, I really just need to stick to saying no, don't buy it, just get an ETF instead. Buy VGS, buy VAS, buy VAE, buy something, not that. That's my key takeaway. See you in the next video. Bye for now.